Imagine raising over $1 billion in a matter of weeks, only to vanish completely. No updates, no refunds, no arrests. In this video, we're investigating the infamous case of the billion-dollar crypto project that disappeared without a trace. Stay with us till the end, because we'll reveal the red flags that investors missed and how you can protect yourself from the next crypto vanishing act. Like, subscribe, and let's unpack this crypto mystery. 1. The hype before the fall. It all started with an ambitious white paper, a sleek website, and a dream. The project promised to revolutionize decentralized data with high-profile advisors, glowing media coverage, and partnerships with supposed tech giants. Investors poured in, eager not to miss the next big thing. The ICO alone raised over $1 billion in under 2 months. 2. Who was behind it? The founding team included a mix of real blockchain veterans and fabricated identities. Some LinkedIn profiles were backed by staged interviews and fake media appearances. A few real people lent their names for credibility, but had no real involvement. The masterminds behind the operation were highly skilled in marketing, storytelling, and deception. 3. The disappearing act. After the initial token sale, activity slowed. Social media posts dried up. Roadmap updates vanished. Investor emails went unanswered. Then one day, the website went offline. Their Telegram group was deleted. The developers' GitHub repositories were emptied. It was as if the entire project had never existed, except it did, along with the $1 billion it collected. 4. Blockchain traces and wallet movements. Investigators traced wallets linked to the project. The funds had been moved through dozens of mixing services, split into smaller wallets, and eventually ended up in privacy coins like Monero. The chain was nearly impossible to follow. Attempts to unmask the senders led nowhere. Whoever ran this exit scam knew exactly how to vanish. 5. Investor aftermath. Thousands of retail investors lost life savings. Some filed lawsuits. Others joined online groups demanding accountability. But with no corporate registration, no legal entity, and no identifiable team members, recovery was nearly impossible. The project exploited loopholes in international law and walked away untouched. 6. The rise of exit scams. This wasn't the first time, and it won't be the last. Exit scams are part of crypto's dark underbelly. They rely on hype, greed, and investor FOMO. Slick branding and charismatic founders create a gold rush atmosphere, and by the time red flags appear, the money is already gone. This project simply executed the playbook better than most. 7. Regulatory gaps and global loopholes. Because crypto operates across borders, jurisdiction becomes murky. Regulators in one country can't enforce laws on anonymous developers in another. Some founders register in crypto-friendly nations with weak enforcement. Without global regulation and better KYC requirements, these scams find space to thrive. 8. What made this scam so successful? The team understood psychology. They created urgency with countdown timers, fake endorsements, and limited token supplies. They used influencers to build buzz. They mimicked the language of successful projects to sound legitimate. Everything looked polished. Until it wasn't. And by then, the damage was done. 9. Lessons learned for crypto investors. Always verify the team. Dig beyond LinkedIn. Check their GitHub activity. Review the white paper for technical substance, not just buzzwords. Follow the money. If a project avoids transparency, it's a red flag. Don't get swept up by FOMO. Take your time. Real innovation doesn't rush. 10. How to spot the next disappearing act. Beware of vague promises and over-the-top claims. Watch for excessive hype and fake urgency. Look out for poor code, weak documentation, and anonymous founders. Trust, but verify, especially in crypto. If something feels off, walk away. Because in a world where anyone can launch a token, caution is your best investment. This billion-dollar vanishing act left behind more than empty wallets. It left a warning, a reminder that in the wild frontier of crypto, due diligence is your first line of defense. If you found this story eye-opening, hit that like button and share it with your crypto circles. Subscribe for more deep dives into blockchain, finance, and the stories no one else dares to tell. Stay smart, stay skeptical, and protect your assets.